Welcome to Share Views with Stefania Barbaglio, who is Director at Cassiopeia Services, and by our guest, Charles Long, who is a Resources Analyst at Beaufort Securities. How are you today, Charles?
Very well, good morning.
Right, my first killer question is, we've had a rebound in resources for just over a year now. Is it going to last?
Well, that is a bit of a killer. It's. I was reading the BMO conference that was last week. There was a sort of result of all the people that attended, filled in a form and answered some questions. And basically, the corporates believe that the Trump effect is going to support metal prices for this year, 2017. The actual companies are more bullish on Trump, whereas the investors are looking at Chinese stimulus and emerging market growth to support oil and metal prices. So I'm kind of more on what the investor sentiment is on that side. That's basically the fund managers that attended this conference. I think that the Trump effect is probably going to be small. I think it will affect feeling and sentiment that can have a short-term impact on prices. But really, he can't make that much happen in the next 12 months. And any big infrastructure projects are going to take several years to get going, to mobilise, to get funded, to get permitted. So I think the Trump effect on commodities is probably going to be smaller. I think if you're a mining company in the States, it's a bit different because it's great if you can get permitting more quickly. Hopefully he can help with the pipelines and the new mine developments. But in terms of the impact on commodity prices, I think probably not. So what's going to happen to commodity prices this year will be dependent, unfortunately, as usual, on what happens in China. How fast China grows. Does it hit the 6.5% that they say it's going to hit? What does Chinese government do with its various policies on closing mines, its environmental policy, taking metal supply and coal supply offline? That's always going to help, and any stimulus packages, that's going to help, and all that sort of stuff you can't really predict.
Well, the Chinese have already told us that the growth is going to be 6.5% this year, so there's no mystery there. But there is the problem. The only thing you haven't mentioned there, which is a negative, or could be a negative, or maybe might say it's a positive, is American interest rates. Apparently, they're going to go up this week, and they'll ratchet up over the course of the year.
Yeah.
How can you have rising interest rates and rising commodity prices?
Well, you can have rising interest rates and rising commodity prices. Just commodity prices in dollars will be tempered by rising interest rates. I guess the question: are interest rates going to go up? And if they go up, is it going to be one move? Is it going to be several moves? I got a chart here on the gold price,
right,
which I think that's the gold price, which may be informative. I mean, the gold price coming off, a lot of that was leading up to the non-farm payrolls last Friday, and then there's a little bit of a bounce off that 1200 level this morning. And you could say that the downward movement is anticipation of interest rates coming up. I think they've got a decision, is it on Wednesday this week?
Yeah. So
if they go up, why has the gold price recovered slightly? Could it be that interest rates aren't going to be moved this week? We've been talking about interest rates being moved for the last 3 years, and how many moves have we had? One, I think, in that time. So those non-farm payroll results were mixed, I think, rather than excellent. Whenever you look underneath the headline, don't look quite as strong as the media perhaps makes out. So I don't know what they're going to do, but I would imagine they probably will increase interest rates. There's a lot of pressure on them to do so. But then the US economy is not in a very strong position. I don't think Trump is going to have a big impact in the next 12 months. And so if we have subdued US growth, maybe even sort of weak recession, it could be that interest rates stay where they are, and then no further changes, and then the gold price starts to rally.
Or they raise them and they have to
reverse them even. Yeah, that makes them look even more silly than the Fed already looks.
Well, you're right about that. Let's go on to the next market, which is a clear bull run here for iron ore.
So that, what you said, your first question, that kind of answers the question. Probably, you look at that trend. And if that bounce continues, we're talking about an upward trend, at least in the first half of this year, continuing. That's going to be great for commodity prices. I think a few weeks ago when I was asked the same question, and it's a bit of a cop-out, I said strong first half, weak second half. And for me, the iron ore price is key because, you know, BHP, Rio Tinto, to some extent Anglo, they're all affected heavily by the iron ore price, and that's what really matters. And so I'll probably stick with that. Strong first half, weak second half. There's plenty of iron ore coming on stream still, and supply and demand is possibly in surplus, certainly very close to being balanced. So.
Charles, is there any particular mining company that you like more than others, and you would like to mention?
At the moment, there's a couple I quite like the look of. Prairie Mining, which I've been talking about recently. This is a coking coal company with assets in Poland. It listed, it was at the back end of 2015, I think it was, but it's been sort of under the radar. It's an middle mass company, so it's the same guys behind Barclay Energia and a few others. So a good technical and successful management team. They're very technical on coal, and they've got some premium hard coal coking asset right in the heart of the steel industry in Europe. And at the moment, Europe imports 80% of its premium hard coking coal from Oz. That costs $40 a tonne, thereabouts, or $35 to $40 a tonne to transport. These guys have got a really nice coking coal project, used to be a mine right in the centre of the steel industry in Europe. So, and they've got another semi-soft coking coal project also in Poland. So that's a really good one. I don't think people know that story very well. And two tier one assets really that they've got in Poland. So it's also quite a good jurisdiction for coal. You know, it's and also the coking coal, the premium coking coal one, premium hard coking coal asset has already got a mining license. So some people have issues with Europe, but they've already got Europe permitting. Yeah. They've already got a mining license. The other one, which is kind of a new story, is Avesoro, which used to be called Aureus, which was a terrible experience for the equity and the lenders. But it's got a new management team that have gone in there that's backed by a chap called Mr. MNG. He's a very wealthy Turkish entrepreneur who's got lots and lots of different companies, and civil engineering is his main business. And they've bought a few mines in West Africa, and they're of those acquisitions, Aureus, which is now called Avesoro, is their only listed one. The rest are privately held. And new management team, they're completely transformed the mining operation there already. They should produce 100,000 ounces this year. I think their costs are going to be about $950, all-in sustaining cost, and things are improving. Restructured their debt. Their debt is only 4% or less per year, and increased throughput, increased recoveries in the plant. So that's a nice story, and it's no longer saddled by debt and underperforming. So yeah, those two companies are worth having a watch.
That looks really interesting. So if we are moving from the mining to the oil and gas sector, what's your sentiment about the oil and gas price?
The oil and gas price, I think the US continues to surprise everybody with their ability to produce oil at lower and lower costs. There was an article by the EIA recently that showed, I think in 2015, costs were reduced by about 30% in the US onshore shale production costs. And they went down by another 20-odd% last year. So, you know, that's a 50% reduction in costs. Remember, there was a time when people were saying, oh, you can't produce onshore shale oil for less than, you know, $60 a barrel. It's not true. Even then, people were producing it for 30, and the average cost has gone down by 50%. And I think this little move down here, that's Brent, and I think WTI last time it was under 50. Is partly down, or major part is down to the US continuing to increase production, producing it at a lower cost, and OPEC not reducing their output as much as they could do.
Isn't that going to start hurting OPEC quite a lot? I mean, you know, they've got no weapon against that, have they, really?
Apart from reducing output even more, and they find that very difficult to do because they need to generate cash, and they're all in deficit. These governments, you know, the Russians, the Saudis, they have budget deficits, so it's a tricky one, and the US appear to be winning this battle at the moment.
Do you think we are going to reach $100 by the end of this year?
No, I wouldn't say so. I find that unlikely, but you never know. There might be a black swan event, maybe. A bit of a war or something. Anything's possible, but just looking at that, it looks like a sort of fairly flat trading in between, I don't know, it could go as low, who knows, it could be down at 40.
Yeah.
But between 45 and 55 seems a sensible levels for Brent.
Now, Charles, I just would like to touch a couple of companies that I know you are following. One is Solo Oil and Aminex. They announced the result of Nituria 2 appraisal well last week, which looks pretty good in theory, but the market didn't react very well. So, maybe if you would like to comment on that, would be great.
Yeah, I mean, I think the result was good. It was within their range in terms of their flow test. I think it was 17 million cubic feet a day. Perhaps it wasn't as high as some people might have liked. That could be one of the explanations for the softening, but at the end of the day I think they had some issues in the well, and the choke size was also restricting the flow rate, but there was no water in the reservoir. There was a strong sustained pressure, which is important, and now they think that the Intoria 1 well and the Intoria 2 well, the reservoir is connected, it's large, it's got no water in it. So we're talking about a very significant resource upgrade on that property. And they're now going to be applying for a development permit and looking probably, well, they're going to do 3D seismic most probably, and then look at ways they can take this thing into production in an EPS, where they would probably sell the gas locally to the local cement factory or the local other factory. So good result. I wouldn't be concerned about the flow rate, and maybe the share price just came off because people like to play the
trader
the
game
drilling bit, and it's all down to supply and demand of shares, and that so I think good result. There's nothing negative there for me. Just one of those peculiarities.
Okay, if we move to another company, Zenith Energy, that is producing oil in Azerbaijan. Now, you just published a note about the company, just showing the potential and the result of the first workover. We know they are going to be available within the next 2-3 weeks. So if you maybe would like, to tell a little bit about what you like about the company, which is the only independent oil and gas producer in Azerbaijan.
So Zenith Energy was an interesting site visit. I went there before, I think it was November last year, or end of October. It's a fantastic location. A huge amount of oil's been produced there historically, but the whole oil field has been badly managed by the Azerbaijan state-owned oil company. They basically, I think they took a Soviet approach, and they drilled a bit, and they drilled vertical wells only. They didn't really understand the reservoir, which, in fact, there's 3 different reservoir types. There's sandstones up at Zardab area, there's volcanics, there's carbonates, and they didn't really understand what was happening and how to best exploit the reserves. So instead of drilling horizontal, which you would a bit like Hurricane Energy has drilled in the North Sea, to hit as many fractures as you can, they just had vertical well programs. And a lot of them worked. I mean, most of them did work, but as you can imagine, if you hit a few fractures, the oil comes up. If you only hit a little tiny vein or tiny joint, or none at all, then you don't have much success. So you really need to be a bit more cute about how you develop this asset. But that's the great opportunity for Zenith, because it was badly managed for a couple of decades or more, and they've gone in there. There's lots and lots of reserves left. It produces 300 barrels a day at the moment, and that is sustained. It's not declining quickly or anything like that. It's a low decline rate field. And they're generating free cash in the country. So it's a fantastic acquisition for Zenith. They're doing a workover program this year. They're targeting 1,000 barrels of oil in about 12 months' time. So I think that's their sort of target for March 2018. I don't know if they're going to hit that, but they're certainly confident of increasing production at very low cost through workovers. And then there's multiple drilling opportunities on the property. So really good acquisition, and I'm excited to watch that. The other thing to say is on the corporate level, Zenith has sorted out its balance sheet a bit. It's got a couple of $1 million of debt left. It's had new equity come in to help fund the first workover program. And so it all looks quite clean and quite nice. And then they sold their Argentinian asset as well. So tidied up the portfolio and the balance sheet, producing cash. and look forward to a good year for them.
Okay, and just to finish up with a few of the more exciting speculative situations at the moment, independent resources, Solo, Aminex, what's your view on that?
Solo, I think we're looking for resource upgrade. I think they're going to grow their resources there significantly, and that should be a positive catalyst there. And then they've got 3D seismic and the potential for a much bigger discovery than they've already got. I mean, they've probably already got at least 300 BCF, potentially more, and that can continue to grow. So that could be a big discovery. Zenith, obviously, we just spoke about increasing production there. IRG, that's an interesting one. That's going to be called Echo, I think. Sound Energy Mark II. It's one of those things. It just depends on what the next acquisition is. You know how retail follow people and success, and in this instance, you've had a success very recently with Sound. Now you've got the same guy going into a new vehicle, changing its name, going to make an acquisition, but the success of the second vehicle, Echo, will very much depend on the quality of the next acquisition.
I've just got that Sound Echo. I've just got it.
Yeah.
It took me a while. It's taken me I've been living with that for at least a week. But on that note, Charlie Long,
surprise me, Zach.
Resources. Well, yeah, I'm just a bit slow. Charlie Long, Resources Analyst at Beaufort Securities. Thank you very much for helping us here with Share Views.
Thank you.
We'll be back next time.